Dear clients and friends, thank you for joining us for this quarter's market review. So for this market review, we'll be covering for the months of April to June, whereby we will invite our head of investment, Chye Hsern, to come to share with us how the markets have been doing over the past 3 months. So I will then come back again to wrap up this whole market review. So I'll now pass over the time to our head of investment, Chye Hsern.
Okay, thanks, Alvin. Thanks for that kind introduction. And now I'll get into the second quarter market review for Providend. So I think one of the key things to note is that in the second quarter, we experienced extreme volatility, but we also got to see that markets are very, very resilient. And despite the period of volatility, we end up closing the quarter at all-time highs. So if you look at this chart, this shows you the year-to-date S&P 500 chart, which I took from Yahoo Finance. So what we have is, you can see that the markets were doing okay in the first quarter. And then, of course, there was this sharp fall caused by the Liberation Day tariff announcements in the US. And the market fell almost 15% or up even 20% from the high. And from there, you can see that there was a slow, slightly volatile recovery. And then now we are sitting at new all-time highs, as of the first week of July. But even at the end of March, we were already just slightly higher than the previous all-time high that we hit in February-March period. So you can see that despite all the economic uncertainty, stocks have proven to be very resilient in the second quarter and have recovered quite strongly. And it's not even just the US market that has done very well. If you look at our local STI index, in fact, this is one of the better performers this year, especially if you convert the back into US dollar terms. You look at, we are also at a new all-time high of above 4,000, in fact now 4,056, and we experienced that same fall in April as the economic uncertainty hit due to the tariff announcements. And then as more information came out, as the tariffs were delayed and now are being negotiated down by many countries, you can see that the market recovered and now we have reached a new all-time high in the local stock market too. Of course, these are very good events for investors that have stayed invested in the market. However, I think something that a lot of investors have been concerned about and are talking about, especially in the second quarter, is the weakness of the US dollar. And we can see that especially from March onwards, we see a sharp fall in the US dollar. This is the DXY index, which is the US dollar index. So it measures the US dollar against a basket of heavily traded major currencies. And you can see that it's fallen about 10% year to date. And so now it's sitting at one of the lowest levels for the year in June-July period. So you can see that one of the key concerns is that even though US markets have recovered, in local currency terms, especially for non-US investors, that recovery hasn't really fully happened because they have lost value in their local, when you convert the investment from US dollars back to that local currency. And we can see that for the Singapore dollar, and we can see that year to date, the Singapore dollar has fallen about 6%, right? And we can see that the sharp fall also happened after the Liberation Day announcements, and it's slowly, this is the US dollar, it's fallen against the Singapore dollar, and it's sharply come down to about 1.274 today. I mean, we started the year at almost 1.37 kind of levels. And of course, it was even slightly higher just a bit before that. So you can see that investors are naturally concerned about the US dollar. And we'll go into it a little bit more in the next few slides. But I think one of the key things to note is that there is going to be this huge discrepancy between US dollar returns and non-US dollar returns, even in our portfolios this year. And that's because, a lot of the underlying assets in our portfolio are US assets, which have done very well in the last decade or so. But this year, of course, due to the FX movements, the performance is not as good in local currency terms. So if you look at, first of all, we see how the markets have done year to date. in June. And these are all, of course, in US dollars. So if you invested in some broad indexes, if you invested in fixed income, the Bloomberg Global Aggregate, it's gone up about 2.8%. If you look at this, is the MSCI All Country World, the IMI index, which has about 99% of the investable market cap in the world. So including developed markets and emerging markets, it's gone up 9.82%. If you look at emerging markets alone, they've done really well because a lot of currencies have strengthened against the US dollar. So in US dollar terms, emerging markets has returned 14.6%. This has also been driven by the strength of a lot of Chinese stocks as investors have started to rotate back into China due to China's AI capabilities increasing a lot, and also due to investors deciding to hedge a little against too much exposure in the US. And so investors have also started to come back to emerging markets, and you look at the performance there so far this year. So this is developed market stocks represented by MSCI World. So it's about 70% US, 30% non-US kind of allocation. And so you can see that in US dollars terms, it's up about 9% and it's done very well so far this year. This is the S&P 500, which is up about 6.2% for the year as of end second quarter. So you can see that given that this has got US stocks and it's doing a lot better than just the pure US index, we can see that non-US stocks are performing a lot better so far this year, and that's carried on in the second quarter. So how have Providend's portfolios done? So in terms of, in the US dollar terms, our portfolios have pretty much kept up with the indexes. So these are our index plus portfolios, which are a mix of our index funds and also a mix of our dimensional funds, which is our more factor-driven investing type of fund. And so a mix of that in these portfolios. And so you can see that we've returned about 9.3% in US dollar terms for our 100% equity portfolio. And as we move down lower in risk, right, to our 100% fixed income portfolio, you can see that we delivered about 2.4% so far this year in US dollar terms for our clients. So I mean, our most common portfolio is probably our 60-40 portfolio, which is currently doing about 6.58% in US dollar terms. So it's pretty respectable performance so far this year for a portfolio that has got 40% in fixed income and 60% in equity. However, as mentioned earlier, in Sing dollars, it's going to look very different because our of the FX movements in the portfolio, as I mentioned earlier, because of the weaker US dollar. And so, as you can see, this is our Singapore dollar performance for the year, and it's definitely much lower than the US dollar performance because of the much weaker US dollar this year. So you can see all of them are positive. They've all done very well. Our fixed income portfolios have held up tremendously because they are hedged to Singapore dollars, so they are not affected by the FX so much. Of course, the hedging cost is going to increase a little bit, but still it's delivered solid positive Sing dollar returns. And across even our heavily equity portfolio, 100% equity portfolio, because of the recovery in markets, because of the strength of stock markets in the second quarter, is delivering a almost 2% positive Sing dollar return, which is quite a strong return so far for a portfolio that has got global exposure. And as you can see, our 60-40 portfolio, which is the balanced portfolio that most of our clients are in, is about 1.7% in Sing dollar terms so far this year. So it's done, our portfolios in Sing dollar terms are delivering positive returns into the end of second quarter, and we expect that if markets continue to be strong, they should continue to deliver positive returns for the rest of the year. So what is going to be driving markets possibly going into the second half of the year? I think one of the key things to keep an eye out for is actually where rates will go, especially in the US. And this is a chart that looks a bit complicated, but what it is the Federal Reserve, the Market Committee, the FOMC, and what they do. This is where all these US central bankers see interest rates being in the future, right? And this is sort of their predictive or their estimation of where they will likely want interest rates to be in the future. So you can see that, first of all, every single dot here is sort of one vote of the FOMC committee, right? So the majority of them in 2025 are seeing that interest rates will likely come down to about 4%. Right now it's 4.5% in the US. So what that means is about 50 basis points rates cut. Right? So you can see that interest rates are likely coming down. You can see overall the trend into 2026, 2027, they expect the interest rates to come down to somewhere around 3.5%. But you can see that there's a lot of uncertainty. The Fed, they have a lot of uncertainty because there's a lot of dispersion in the dots. Like typically if it's very certain, you would see like all the dots. You would see all the dots in one straight line, right? But now they are very uncertain whether it's going to be 3.75 or 3.5 or 4%, in early 2026 and so on and so forth. So you can see that even the central bankers are quite uncertain about where the economy, where the data is going to go. And so what we can expect is, first of all, we can probably expect some rate cuts, because as long as inflation doesn't rear its head, and inflation hasn't really come back yet, not in the US, not in Singapore, not in other economies, we can expect that because likely economic growth will slow due to a lot of the uncertainty around trade policy, we are going to see that the Fed will probably cut rates. So you can expect slightly lower shorter term rates. But I think the other thing to note is that there is a lot of uncertainty, because if the Fed, with all the information they have at their disposal, I mean, they have the most updated economic data, business data, etc., and they are uncertain where things are going, that they cannot, all of them cannot conclusively decide where they want rates to be. I mean, it's going to be a very uncertain time, especially going into the third quarter and the second half of the year. So I think some of the key things to note is that we all should really stay diversified, and of course you should talk to your investor, to your advisor, if you have any concerns about the markets. One thing I'd like to highlight though is that a lot of talk has been about the US dollar weakening a lot in so far in 2025. But if you go back, this is the same index that I showed earlier, the DXY index, right? But instead of year to date, I'm showing it for its most of its history, which stretches all the way back to the 1980s. You can see that actually where it is right now, right, is not very far away from where it was in the decade prior, right? In 2015 to 2025, the last 10 years, it's sort of come back down to average. And in fact, it's still way higher than it was in the period of the mid-2000s to 2015. During the GFC and after the GFC during the Eurozone crisis. Right, so the US dollar has only been stronger than this for this short period during the dot-com bubble, and then after that it steadily trended down post the dot-com bubble as Asian economies grew stronger. This was 2000 to 2008 kind of period where we had very strong growth in Asia. So you can see that the US dollar is not behaving in a very strange way, right? It's not very far from its historical average. And so, yes, it's been volatile this year, but it's not, FX and currencies can go up and can go down, and it's something that we should account for in our investments. So it might be a bit of a tougher year for Sing dollar returns for our portfolios and for investors in US assets, but as we can see from history, it's not something that is too strange, and that probably once the volatility in the FX stabilizes, we'll be able to capture better returns in local currencies going forward. So to sum up, they say that bull markets climb a wall of worry. Right? There are all sorts of concerns and uncertainties now, yet markets are at all-time highs. So despite the wall of worry, we are sort of still at all-time highs. And so, investors really should try not to predict the markets. It's really tough to know where the markets are moving. A long-term investment plan, keeping a diversified portfolio so that you can capture the returns wherever they come from, is likely to give you a much better investment experience overall. Thank you. And to conclude, I will let Alvin make the closing comments. Thank you.
Thank you for the insights, Chye Hsern. So as what Chye Hsern has shared with us, even though we are now at a market high, understand there is also a time of uncertainty with like the tariffs and also the tension in the Middle East. So how then, as investors, how can we manage our money during this time of uncertainty? It is quite common when we see that markets are at an all-time high and there's some element of uncertainty such as what we are facing today. It is common that investors might want to consider selling off their investments. And there are a couple of reasons why they might want to do that. Number one is that they want to take profit by selling it at a high now. And another reason could also be that they want to protect themselves from the downside, just in case the market were to come down in case of the market uncertainty. So we have to recognize that if we were to do that, if we want to sell off and make a profit at the market high, we have to recognize that we are actually making essentially two decisions instead of one decision. But we need to decide firstly when to sell off our investments, and also we have to decide when to buy in our investments again. So we have to decide that re-entry point. And this can be quite challenging, and in my opinion, the second decision of when to re-enter the market is actually the more challenging decision. Why so? Let's run through the scenarios. So let's say you really decided that you want to sell at the market high. There could be likely two scenarios. First scenario is, let's say you invested and then market really come down. By right, you should be putting your money back into the market and investing in the market. But we know that there's a lot of emotions when we do investments. So when markets come down, there might be that fear that market will continue to drop. And let's say you are really concerned that market continue to drop and you decided to wait it out. So by waiting out, suddenly there's a market rebound, and we know that market rebounds can come very quickly. And now you end up in a position that is probably even more expensive than your original starting point. Wouldn't it be even more difficult now to decide to invest your money into the markets again? So that will be that situation if market come down. And what if, let's say, I sell off and then markets go up? I think more likely than not, for most of us, we will then feel that it's not a good time to enter. We have missed the boat and we might not end up investing until the next market comes down. So because of that, we might have missed out that opportunity cost of investing in the market. So it is actually quite challenging to guess where the market is going to go in the short term, because markets can be very unpredictable in the short term because there are many things that are happening behind the scene that we have no access to, that we do not know about, that can affect the market going up or going down. So in the short term, things can be very unpredictable. So then what is a better alternative to invest? So to us, an easier alternative, and the way that we advocate for clients and people to invest their money, is to focus more on time in the market rather than trying to time the market. So time in the market is basically us investing long enough using money that we can set aside for the long term. And in doing so, we can capture the long-term returns of a globally diversified portfolio, rather than trying to time the market, when to buy, when to sell, which can really be quite a stressful experience. You might be wondering, why do Providend advocate time in the market rather than timing the market? Let's look at this evidence here. So what you are seeing in front of you is if you had take $1 and you invested into the MSCI World Index back in 1970. So the MSCI World Index is basically a diversified fund that invests into mainly the developed countries. So your $1, if you have invested into the MSCI World Index, it would have experienced negative events such as high inflation. It would have experienced wars. It would have experienced the subprime mortgage crisis in 2007, 2008, and even the more recent COVID-19 pandemic and the Israel-Iran conflict. You realize that despite all these negative events, your $1 would still have grown to as high as $126 in 2025. Alright, this shows us that it's not so much about trying to time the market, but it's really the time in the market, being invested long enough to capture the long-term returns of investing into a market. To summarize, for most of us, when we do our own planning for our finances or our wealth, we should have 3 pots of money. The first pot of money is for our emergency funds. Ideally, we want to have cash to cover about 6 to 12 months of our expenses. So in case something were to happen, example, we lost our job, at least this money will be able to tie us through that 6 to 12 months until we find another job. So we should also have another pot of money for our short-term goals. This could be things like, example, I want to save up money for my renovation in 1 to 2 years. So because I have a very short time horizon or very short runway, I cannot afford to take on too much investment risk. So I have to invest into safer instruments such as fixed deposits, T-bills, Singapore savings bonds, etc. Then the last pot of money, these are money we do not need in the near term. These are money that we can set aside for the long term, for example like 10, 15, 20 years. Then we can consider investing into a globally diversified portfolio. And it's important that when we invest to such portfolio, we have to stay invested. Even during market uncertainty such as the period now, we have to stay invested for the long period of time so as to capture the long-term returns of a globally diversified portfolio. I certainly hope you have found what we have shared today to be helpful for you. I wish you all the best on your investment journey. And as usual, if you have any questions, please reach out to your trusted advisor at Providend. Stay safe, and we'll see you in the next video.